Good morning. Welcome to Stock Market Today. It's Thursday, October 31st, 2019. Happy Halloween. This is Dan Russo, the Chief Market Strategist at Chaikin Analytics. Find me on Twitter at DanRusso_CMT. Stock Market Today brought to you today and every day by Chaikin Analytics. Head over to ChaikinAnalytics.com/today, where you can sign up for a free email that gives you daily stock ideas to consider in your inbox every trading day before the market opens. So U.S. equities were mostly higher in Wednesday's trading, ending near the best levels of the day after the Fed cut rates by 25 basis points. Widely expected. Treasuries were higher on the day, sending yields lower. The dollar was weaker on the major crosses. Gold was up 40 basis points. WTI crude finished down 90 basis points, though off the worst levels of the day, following an unexpected inventory build in the U.S. And as we get to the desk this morning, futures are down about 30 basis points on news that China has expressed doubts about a long-term trade deal. Asian markets were mixed overnight. European markets are trading lower. Treasuries are extending their post-FOMC rally with the curve flattening. The dollar is weaker against the major crosses. Gold up 70 basis points, and WTI crude is little changed. And as we look at the S&P 500, we had another all-time closing high yesterday, holding above that breakout level that we have been highlighting. Now, key support, and I stress key as kind of longer term structure of the trend, is near the 200-day moving average, now near 28.85, and then those August lows are really important. But as we continue to drift higher, we have to start to think about near-term support. And to me, near-term support is around these gaps. You can see them here. 1, 2, 3, 4 gaps in and around the 29.50 level. So to me, that's the key level that has to hold in the near term on any pullbacks. The RSI is in bullish ranges and moving higher, confirming the price strength that we're seeing. And now Chaikin money flow has turned bullish. We've been spotlighting this for the past few days. After this dip, we've noted some improvement, and now we've cut back into bullish ranges. So indicators in line with price continuing to hold above the breakout level. We have our key support levels. Resistance is kind of tough, right? With all-time highs in play. Eventually, we'll start to carve out a resistance level, but for now, we are at all-time highs. And as I said, the futures are trading slightly lower here this morning. Now let's get into our market in a minute. What are we writing about in the note today for Chaikin Analytics clients? Well, SPY reached another all-time high. We touched on that. Thursdays, we do breadth, right? We look at breadth metrics across time frames, and breadth metrics continue to improve with the market. That is encouraging. However, we are mindful of the negative divergences, and we'll point out what that means a little bit later on in the show, which is kind of when we see divergences, we like to sit up and take notice. Now, large cap value has been outperforming of late. We've been talking about it for the past couple of weeks. We're going to lay it out here in the chart. And as I said, futures do point to a lower open here today. Now, the power bars for the major indices, they saw improvement yesterday, as you would expect, with the market moving higher for the most part. The Dow added 32 basis points, 5 bulls to 9 bears there. S&P 500 up a like amount, 32 basis points, 111 bulls, 98 bears there. NASDAQ was a slight outperformer on the day. 28 bulls, 18 bears there. We're going to want to watch the NASDAQ today because a lot of moving parts in and around earnings. Apple's report, stock is trading higher. Starbucks trading higher. Names, some of those key NASDAQ names are trading higher here this morning. We also heard from Facebook. Small caps underperformed on the day, 657 bulls to 312 bears there, but they were down 30 basis points on the day. Nice rally in bonds to send yields lower. So according to the Chaikin Power Bar, small cap stocks and large cap stocks are bullish, but the major markets are mixed. It's in our stock of the day now. Stock of the day comes to us from one of the groups that we've been highlighting a lot recently, and it's Qorvo. QRVO, the ticker symbol there from the semiconductor group, flat on the day yesterday to close at 79.85, but it does have a very bullish Chaikin Power Gauge rating due to very attractive financial metrics, very strong earnings performance, very positive expert activity. So weak price volume activity of late as it chops around. However, the 20 factors, 5 in each of these 4 categories, give us our very bullish rating. Very bullish rating meets a strong trend as the stock is above our rising long-term trend line. It's in a strong industry group. We've been talking about semis for quite some time. So certainly the type of name we want to consider as a bullish idea. Market and model, well, they're in agreement. Very bullish rating, outperforming the market with the intensity of outperformance picking up of late. Now, we do have some bearish money flow here as the stock is trading near highs. It's a little bit of a red flag. And overbought, oversold indicator is rounding out of an oversold condition, overbought condition rather, and heading towards oversold levels. So for me, I want to see Corvo hold above this $78 to $80 level, produce an oversold condition, and that sets up a better entry point. But I do think that we want to continue to watch the semiconductors. We talk about them quite a bit. To the extent that semis are outperforming the market tends to run higher. It was one of the key legs to our argument that the market was likely to break topside from the consolidation, and so far that has played out. I think Corvo's an interesting name. I think if you're a little bit on the more aggressive side, the weight of the evidence certainly supports being there. If you want to be a little bit more conservative and wait for that oversold reading, I can't argue with that either. Let's take a look at our sector tracker now. Movement in the major sectors over the last 5 days. Nice to see tech holding at the top of the list. We'll see if it can hang on to those following those key earnings reports last night. Healthcare, another one of the larger weights in the S&P 500, starting to come on, and that's a bullish development as far as I am concerned. Materials, industrials, and financials, all part of what could potentially be a rotation into more cyclical names, rounding out the top 5 sectors over the past 5 days. Discretionary, staples, and comms are middle of the road. We have our bond proxies still under pressure, even with the rally in treasuries yesterday. Utes and REITs did well, but over the past 5 days, they have been underperforming, and we want to watch the trend in rates as a read on these bond proxy areas of the market. And energy, after trying to stage a counter trend rally, has returned to the bottom of the list of 5-day sector movers with some weakness in crude oil. Energy, the fundamentals there just still remain bearish. It's hard for me to get excited that we're seeing a sustainable turn in that space. Now, our industry in focus today is interesting because it's one that we've liked a lot. And now I have to say that our tone has changed, right? Similar to what we talked about earlier in the week with insurance. Well, aerospace and defense outperformed the market over the past 6 months by nearly 2%. However, we have a change of trend here, a change of personality, if you will. Power bar ratio, which measures future potential, is weak. 8 bearish stocks, 7 bullish stocks. It's currently ranked now in the bottom third, 14 of 21 subsectors, having moved down 3 slots over the past week. Some of the indicative names there that we certainly want to avoid or even potentially look for bearish opportunities if they set up. Axon Enterprises, AAXN, very bearish rating. Kratos, KTOS, very bearish rating. And Boeing, right? Name that's been in the news a lot lately. Boeing has a very bearish rating in our model. So these are the names that we want to avoid. And if we take a look at the aerospace and defense ETF, we can see what's gone on here. We can see that personality change. First and foremost, we went from a bullish rating to a neutral rating. We went from a strongly outperforming industry group to one that's now underperforming, and money flow for the first time in a while has turned bearish, and the intensity of that bearish money flow is some of the worst that we've seen over the past 12 months. Neutral power gauge rating, weak trend with the fund below the long-term trend line. You can see, right? S&P 500 is trading at all-time highs. Same cannot be said for the aerospace and defense industry group. So this is an area of the market that we've liked, but we don't remain dogmatic in our views. When the facts change, we change our mind. I can no longer sit here and be a table-pounding bull on the aerospace and defense group, similar to the personality change that we've seen play out, we've been talking about in insurance within the financials group. Taking a look at what's trending now. Yesterday's S&P 500 movers and shakers are gainers and losers. Garmin's earnings sent that stock higher by nearly 10%. Centene, CNC, Medicaid contract down in Texas gave that stock a pop of over 8%. IPG Photonics rebound. Remember, it was the big loser on this board yesterday. FMC earnings sent that stock higher by over 7%. WellCare Group, WCG up over 5%. following their earnings announcement. The loser side of the board is predominantly earnings related. CHRW down 15% on earnings. MCK earnings send that stock lower by nearly 8.5%. Yum Brands, ticker YUM, with a bearish rating, down 6% following their earnings announcement. Devon Energy, no real news there, likely down with the rest of the energy complex to the tune of about 5.37%. And JW Nordstrom caught a downgrade. Stock downgraded by one of the sell side shops, which took 5% out of the stock on the day. Turning now to what the key charts are. What are we really writing about? As I said, it's Thursday. So Thursday's the day we look at market breadth. And I get a lot of questions about my publishing schedule and why we look at the same things over and over. And the reason we do that is to try to identify changes as early as possible. Now, breadth continues to improve. We're looking at the percentage of stocks above their 200-day moving average continues to move higher. Percentage of stocks above their 50-day moving average continues to move higher. The advanced decline line for the S&P 500 continues to move higher. So that is encouraging, right? We want to see breadth improve. The fact that breadth held above key levels during pullbacks, 50%, for the percent over their 200-day moving average, 30% for the percent above their 50-day moving average, was what gave us a clue, another data point, if you will, that the market was likely to break topside from the range. And while breadth continues to improve, and that is encouraging, we want to be mindful of a subtle change. And that is one of negative divergences. If we look here, the percentage of stocks trading above their 50-day moving, 200-day moving averages, rather, while moving higher, is making a series of lower highs. So that's a non-confirmation. S&P 500 is trading at all-time highs, but the percentage of stocks above their respective 200-day moving average has not broken out yet. We will defer to price, but this is just something to be mindful of. Readers of my notes know that on a short-term basis, based on our proprietary overbought, oversold indicator, the market is overbought. So if we add these divergences, for me, I think you want to stick with your long positions that are above your risk parameters, but it's hard to be super aggressive adding new positions in light of the overbought condition and in light of these negative divergences that we're seeing here in breadth, right? Similar negative divergence at play with the percentage of stocks above their 50-day moving averages, right? Series of lower highs. Again, has not broken out yet. Now, this may change, but it's just something to be mindful of. The way I like to think of it is it helps us calibrate how aggressive we want to be, putting new money to work here and now, right? We've been talking about the market's likely to break topside. We've been identifying bullish opportunities to take advantage of that. If you're in those bullish opportunities and they're working, I say stick with them. But it's hard to get excited about putting new money to work, given the overbought nature based on our short-term indicator and given these divergences that we are seeing in place here. Now, right? Fed day yesterday, we'd be remiss if we didn't take a look at yields, right? And yields fell post that FOMC meeting, right? Yields have been moving higher in anticipation of what we heard yesterday. And basically, Chairman Powell gave the market what it was looking for yesterday. The market was expecting a 25 basis points cut. We got it. The market was largely expecting commentary around the fact that this is likely to be a pause. We got it. In anticipation of that, rates started to move higher, right? Now we can see the 10-year yield on the news. Really, it became kind of a buy the news event in treasuries as yields have now ticked lower. But they are above a now rising 50-day moving average, still below the 200-day moving average. I think that there's probably resistance at around the 2% mark. And if we look here, we can see that momentum appears to be shifting into bullish ranges. So this is one to obviously play on and keep an eye on a little bit further. But it's interesting to me that as rates have been rising, large cap value has started to perk up as leadership. Here's the IVW above the 200-day moving average, S&P 500 value ETF trading up near all-time highs, confirmed by momentum, which has shifted to bullish ranges. And if we look at IVE relative to the S&P 500, we can see it is now moving higher, signaling outperformance. That'll wrap us for today. I'll be back tomorrow. Have a great Halloween, everyone.
Today's market volatility provides savvy traders and active investors with an abundance of profitable opportunities. At the Traders Expo Las Vegas, November 7th through 9th, over 75 of the most respected traders in the world, including Dennis Gartman, Tom Sosnoff, Todd Gordon, and Tom DeMark, will explain how they're adapting their strategies and share the specific trading opportunities they've identified in equities, options, forex, futures, cryptocurrencies, and more. Claim your free pass to join them at tradersexpo.com.